Hello, Ira Coiner here from Triathlon Partners TV. Thank you very much for tuning into this episode. We'll be discussing the U.S. presidential election and its effect on the stock market. Now, election's happening today. The results, who knows? Might be tonight, might be next week. We don't know. But people have been asking me, Ira, what do you think? Who's going to win? And what's going to happen to the market? If Kamala wins, Trump wins, which way is it going to go? Now, I don't know. I can guess. I can have educated guesses, and I think my education guesses are pretty good. But one thing that I am very confident about is that the market will be a lot more volatile in November. And it's not just because of the candidates that are running today, but historically, November is a much more volatile market than other months, right? The volatility usually is about 10 to 20% higher across major indexes in the month of November than the average month. But in presidential years, the November presidential years tend to be 30 to 50% more volatile than the average month of November, right? So that's even greater than for a regular month, but it just means that we don't know what's going to happen. Things are going to be very volatile. And what we really want to do at Triathlon Partners, and our goal is to have consistent returns over time. And that means let's mitigate this volatility and minimize the impact it has on your portfolio. So the things we're going to talk about today are the three major products we think you need to have in your portfolio to lessen the volatility, minimize losses, and perchance give you a greater chance at gains. So overall, we're looking at taking the volatility, minimizing it, and making sure that our clients and ourselves, that we do very well overall long term. So the three products, as I said, the first one are structured notes, and we've gone over them in several videos and episodes beforehand. And I'd like to highlight one note that I've seen recently. It was issued last month, and this note was based on 2 years on the S&P 500. So for 2 years, you'd hold this note, and it would perform just like the S&P 500, except there was a cap at 23%. So 23% over 2 years means you're averaging 11.5% a year. S&P 500 over time averages 8.5%. So you're capped out at a level that's higher than the average. All right, we have good years, we have bad years. Who knows where it's going to be? But average, we're above average. That's great. But did you know this note took the first 10% loss? So if the market after 2 years was down 5%, you'd be made whole. If the market was down 15%, you only lost 5%. So from the standpoint, when we look at the risk return on this note, it's fantastic because that first 10% loss is taken, and you're going to have an above average return in a positive market. So fantastic. Those are the types of products we like to utilize in our portfolios because they limit the volatility when we're going to most likely see a very volatile November across different sectors and across different indexes. Number two, we've spoken about this quite a bit. They're called RILAs. They're an annuity product. So anyone who has a legacy 401k, these are a great product to roll them into. They're treated the same way tax status wise. And what they do is they have protection on the downside. And in exchange for that protection, you get a cap on the top side on how much you're going to earn. All right, so we're not really going to focus on the limit so much because they're quite generous. We can look at just recently what is being offered out there. If you would buy, believe it or not, in the NASDAQ 100, the triple Qs, for 1 year's time, you have a buffer of 10%, meaning the first 10% loss in the NASDAQ, in the index, you get refunded 100% of your money. That's fantastic. So if the market's down 5, 8%, end of the year, you're flat. If it's down 20%, well, you have that 10% buffer and you're only down 10%. All right, it stinks to be down money, but you're doing much better than your neighbor. Right? In return, you have a cap, right? So that's the maximum you can earn in the year. And on this one, the cap is 20%. That's pretty great. What does the NASDAQ usually do in the year? Well, last couple of years has been pretty fantastic. We've had some down years and up years, but it's averaging 13, 14%. Let's say on, we go back to normal times and it's 12 or 11 or 10. Well, that 20% cap isn't very restrictive considering that the first 10% loss is refunded, right? And we can even go something if you're worried about the market collapsing 20%. Well, with that 20% buffer, the cap is still 14%. So these are really fantastic rates, fantastic risk returns that really take the volatility out of your portfolio and allow you to still have above average gains, right? Even if we go to something like small caps, which are very volatile, they have a 10% buffer right now, first 10% loss for a year, and you're still able to earn up to 24.5% a year. That's fantastic because let's face it, if you had this position in your portfolio for the year and the market was up 24%, 20%, 22, 24%, 24.5, whatever it's up, once it gets to that level, you're tempted to sell and take profit, right? If you're going to do that, you have wasted money by not buying this buffer, right? Because you've just locked in, you've capped yourself. The product hasn't capped, you've capped yourself, but you didn't have this buffer. So if that's the way that you look at your portfolio and you're happy with gains of that type of return, you might as well take this buffer. It's right there for the taking. And number 3, product we really like are indexed universal life policies, right? We've gone over them several times. They have the same structure with the caps and the buffers on the investment portion. And the way we structure them is to buy the least amount of insurance so that we have the maximum amount of gain on our capital. And why do we want that? Because the gains are tax deferred. And when we structure the policy like this, you will be able to withdraw money tax exempt. Now, the markets are going to be more volatile. This is life insurance. You're always going to die, and you're always going to have to pay taxes, except with this product. So this product's an anomaly, and if you can not pay taxes, and if you think taxes are going up after the election, then this is a fantastic way to enhance your returns because this money will never get taxed. So from that standpoint, these are 3 products we really like, and they're very important to reevaluate when we come into a period of time when the market is very volatile. These are long-term investment contracts, but when we look at the market and you're going to see it be volatile over the next month, you're going to be upset you didn't sell, you're going to be upset that you're still long, or you're going to be upset that you didn't buy. And because you had cash on the sidelines, these products allow you to be involved in the market and to restrict the amount of loss that you do have. All right, so if there are any questions, please feel free to contact us. All our information is at www.triathlonpartners.com. Please, we like our stuff here. So thank you very much for our supporters. We like our thumbs up, friends, and our followers. So please click those buttons. Let us know how much you love us. And everyone, please have a blessed day. And I will be sharing the disclaimers with everyone because I know everyone loves the disclaimers.